The stock market is back at all-time highs, with new record prices being hit, interest rates getting slashed, and investors rallying behind a new age of technological domination. One can only look at the incredible prices and wonder if we're headed towards the stratosphere or if we're teetering before the precipice. In this video, I want to take a look at what expectations are already baked into the current price of the market, and if we're likely to see a scenario where we surpass investors' expectations or undershoot the mark. And what would the aftermath of something like that look like? My name is Paul, and so far I've invested $100 per month into Canadian securities for 33 months straight, with the intention of emulating the journey of a hypothetical Canadian who will never be able to max out their tax-free savings account. I'm doing this series to try and show that by following a disciplined plan of investing $100 every month, the average Canadian will be able to achieve retirement and live happily off of their investments in financial freedom. The S&P 500 is essentially a basket of the 500 largest US companies that are publicly traded on the stock market. And currently, the average price to earnings multiple of the index is almost 30. To put that into perspective, assuming the underlying businesses don't grow their earnings at all, at this price multiple, one would expect their invested capital to double every 30 years. That's quite a long time, considering that you could alternatively invest in treasury bills that would double investors' dollars in around 20 years. And treasuries carry a lot less risk since the money is backed by the US government and isn't dependent on companies creating earnings. However, it is expected that these major companies, which are vital to every aspect of the economy, will grow. The multi-trillion-dollar question is, how much? Well, historically, earnings growth of the S&P 500 has been pretty steady at about 8.68%. But post-pandemic, things have been a little bit slower. Even with the government stimulus putting more cash into the hands of consumers, earnings have broadly decelerated. The 5-year growth rate is a lot closer to 7.5%. But again, this was boosted somewhat by quantitative easing. Even more recently, the 1-year earnings growth has come down to just 3.72%, which is lower than the return that you would get from treasuries. Now, it also needs to be mentioned here that the Federal Reserve did implement interest rate hikes, which, to paraphrase Warren Buffett, act like gravity on the economy. And more recently still, the Fed has begun lowering rates, which should put us in a position to see better year-over-year earnings growth come 2025. That said, with stocks making up the index priced at 30 times earnings, achieving a high enough growth rate to make these figures make sense could be difficult. See, if we just go back to consistent 7.5% earnings growth, it would take investors nearly 16 years to get a return equal to what they put in. But what if earnings quadrupled from where we're at now, going up to 15%? Unfortunately, even in that scenario, things don't look so good, since it would still take investors nearly 12 years to double their invested capital. Plus, it's worth noting that there has never once been a single 10-year period where the S&P averaged earnings growth of 15% or higher. The best ever on record came between 2009 and 2019, with earnings growth averaging 13.48% per year. Though even this growth is heavily cherry-picked, considering it's sandwiched between 2008, where earnings nosedived by over 40%, and then of course we had the COVID shutdowns of 2020, where earnings dropped nearly 15%, helped majorly by government stimulus, I might add. In fact, most of the S&P 500's 10-year periods of double-digit plus earnings growth was largely due to positive outlier years that could mainly be chalked up to recovery from some crash that happened the year before. Needless to say, it seems fairly unlikely that we'll have a record-breaking 10-year period of 15+% growth. But even that doesn't justify today's prices, as I said before. Even crazier is that bumping the growth rate to 20 or 25% also simply isn't enough to make the current valuation sustainable. If an investor was to expect the historical average return of 10% on their investment into the S&P 500, earnings would need to increase by a whopping 37.3% per year for a period of 7 years. Given this context, I would say that the broader market looks really expensive at the moment. And I hate to be the bearer of bad news, but we aren't even coming off of a significant crash that will help to pad out a strong 10-year growth rate. Quite the opposite, actually. After the 2020 earnings decline of 14.92%, 2021 marked a historical rally in earnings that notched the second best one-year performance in the S&P's history, hitting 49.24%. Now, that's not to say that the companies in the index can't pull off a new era of growth that puts all others to shame, but the chances are about as likely as winning the Powerball and getting struck by lightning on your way to cash in the ticket. In reality, we're much more likely on track for an average to slightly below average decade when it comes to earnings growth. Does that mean that you should go out and buy put options or short the index? No, probably not. Timing the market is almost impossible. There are many people who are brighter than both you and I combined who have gone broke betting that a crash is right around the corner. Just because in the short term prices don't match the long-term expectations doesn't mean that rationality will kick in overnight or over the next year or 2 or 3. The market can, and more importantly has, gone to higher valuations than it is currently at now. Take for instance the peak of the dot-com bubble, where the S&P hit a PE ratio of over 47 before crashing 50% in the following year. Meanwhile, PEs of 30 were being hit for the first time several years before. Plus, even though we haven't seen this happen before with the S&P 500, there are other individual securities that have become incredibly overvalued at one point in time, and rather than crash, they simply hold on to their current valuation for a decade or so until the earnings catch back up to the price. So if it's risky to bet against the market and very expensive to buy shares of the index today, what should you do? Well, that depends entirely on your investing timeline. If you're investing for the long haul, you can probably just continue investing as usual. You might experience a short to medium term crash, but over the long term, things will likely recover after a handful of years or so. And if you're dollar cost averaging along the way, you'll also be able to take advantage and buy some of those shares at the reduced price during the crash. Now, if you're planning to take out a significant chunk of your investments for a large purpose, or if you need that money for retirement in the near term, then it might be worth considering taking some gains while the taking is still good, and rolling that into treasuries that will at the very least keep up with inflation, and are generally quite liquid, allowing you to sell your notes and buy back into the market when prices have come back down to earth. Personally, when it comes to investing, I don't like to participate unless I have an advantage, and with the S&P where it is now, I definitely feel like the odds are stacked against me. And while I have held shares of the Vanguard S&P 500 ETF in my tax-free savings account since 2017, I've decided that it is now time to secure my gains by liquidating the position and reallocating my capital to where I believe it is more likely to further appreciate in value. So, come Monday, I will be selling my position in the ETF, assuming that it doesn't crash back down to a reasonable price overnight, in which case I'll just have to take solace in having called it right before it happened. That said, I do not hold any shares of VFV in the monthly portfolio, but just like the broader market, everything I do hold is up this month. First up, we have the portfolio's largest position, which is held in a REIT that specifically rents out residential apartment units in major cities across Canada and the United States, that being the Morguard North American Residential Real Estate Investment Trust. And Morguard was the portfolio's worst performer this month, but it still churned out a respectable 2.5% gain, and that's before including the distribution that it pays shareholders every month. Next is the portfolio's smallest position, a company that lends out money to subprime borrowers. But unlike the unethical practices that might immediately come to mind, goeasy, the company in question, aims to provide its borrowers with flexible, easy to understand loans with no hidden fees or sneaky maneuvers. And this month, goeasy was up 4.45%. And last month was the first time in quite a while that I actually decided to pick up goeasy shares. Last up is the holding that sits between the other two, a company that owns and franchises out multiple different restaurant banners like Cold Stone Creamery, Wetzel's Pretzels, Famous Dave's, Baton Rouge, and over 80 others. The company I'm talking about is, of course, MTY Food Group, and it had been on quite a cold streak over the last few months, but September bucked the trend and shares were up 10.7%. So, of course, with all of the holdings going up, the market value of my portfolio has increased quite nicely and is now sitting at $3,814.07, which is up over 10.3% on the $3,456.45 that was invested. And that book value figure does include the reinvested dividends. Without including those, the portfolio would be up over 15.5% or $514 on the $3,300 that I personally deposited into Wealthsimple. Taking a look at how my portfolio performed against the benchmark ETFs, like I said earlier, everything was up, but we still performed pretty well considering the two Canadian benchmarks represented by the purple and blue lines received their large quarterly dividend payments this month, which helped to boost their 1-month performance. Nevertheless, the S&P 500 continues to reign supreme with over $360 more in unrealized gains than the second place global value ETF. Centering back in on my portfolio marked in green, we're still in last place, but we're right back in the swing of things with only a couple $100 away from the rest of the pack, and we're only 1% away from catching the goal line marked with the red stars, which represents a 12% annualized rate of return. So who knows, another month or two and the monthly portfolio might be back on top. Regardless, I've already got this month's $100 waiting in the account on Wealthsimple, and I also have some dividend income that was earned by our shares over the last month. So to start things off, I'm going to pick up 4 shares of the Morguard North American Residential REIT, $20 worth of fractional shares in goeasy, and last up, I'm going to put everything that's left over into a fractional share of MTY Food Group. And after finishing investing October's capital, I was able to pick up 4 shares of the Morguard North American Residential REIT for $18.62 each, 0.1087 shares of goeasy at a cost basis of $183.97 per whole share, and 0.3053 shares of MTY Food Group at a cost basis of $46.97 per whole share, leaving my portfolio with no cash left over after my orders were filled. So, as of the market's close on Friday, October the 4th, the portfolio has 151 shares of the Morguard North American Residential REIT worth roughly $2,822, about 15.9 shares of MTY Food Group worth over $748, and 1.87 shares of goeasy, which are now worth over $342. Moving to the dividend tracking chart, in September, the portfolio only brought in $8.82, which for the first time was more than I actually expected, but only by 1 cent. And it was just the result of a simple rounding error on my part. So reset the accurate monthly projections back to 0. We were getting so close to a full year with no misses, but we're just gonna have to pull ourselves together and try to get through this disaster. Anyway, all of this month's distribution came from Morguard, and $8.82 is enough to buy this Halloween pack of 40 mini Rice Krispie Squares, perfect for giving out to all of the trick-or-treaters that come by, as long as there's less than 40 of them. But this year I'm turning out the lights and just hoping I don't get egged, because all of that money has been reinvested back into the portfolio. And next month, the portfolio is set to bring in $11.13 in dividends coming from both Morguard and GoEasy. And we're now over 65% of the way to our goal of achieving $130 in cumulative annual dividends by the end of fiscal 2024. Switching over to the yield on cost, as of this moment, if I were to just leave the portfolio as it is and collect the dividends in cash for the next 12 months, assuming no additional dividend hikes or share purchases, I can now expect to receive $138.31, which is a 2.38% increase from what was expected last time. As for the portfolio's percentage yield on contributed capital, this month it dropped by 1 basis point to 4.07%. And that's going to conclude this month's episode, so thank you all for watching. But before you go, please remember that this video is not financial advice and that I am not a financial advisor. This video was made entirely for the purpose of providing inspiration and insight into my personal investment decisions, and it should not be used as a substitute for doing your own research. This video does not have the information required to make good investment decisions on individual securities. So again, I am not a financial advisor. I'm just a Canadian who likes to invest and share my opinions with others. And in doing so, I hope that I was able to provide you with something of value. And if I did, then please consider sharing it with anyone else who may also benefit from it. Thank you for watching all the way to the end, and enjoy the rest of your day.